Most entrepreneurs obsess over making money. Very few obsess over keeping it. That difference is why some founders peak early and disappear, while others quietly compound wealth for decades and eventually control rooms, industries, and legacies. Here's the uncomfortable truth. Getting rich is often a result of focus and risk-taking. Staying rich is the result of discipline, patience, and structure. If you want to maximize and fully diversify your investment portfolio over 1 to 5 years, you must stop thinking like a hustler and start thinking like a capital allocator. Let me walk you through how billionaires actually think about money and how you can apply the same framework starting today. Year 1. Protect before you multiply. The first mistake most entrepreneurs make is believing that confidence is a substitute for risk management. It's not. Year 1 is not about explosive growth, it's about survival and optionality. The smartest investors begin by separating their money into 2 mental buckets: builder capital and investor capital. Builder capital is money you actively use in businesses you control. Investor capital is money designed to grow quietly without your daily involvement. Mixing the two is how egos destroy fortunes. At least 50 to 60% of your total net worth should sit in defensive, diversified assets, global equities, high-quality bonds or cash equivalents, and a small hedge against inflation, such as gold. This portion of your portfolio exists for one reason: to ensure that no single mistake, downturn, or crisis can take you out of the game. Liquidity is not laziness. Liquidity is leverage. Having 12 to 24 months of runway gives you the power to make decisions from strength, not desperation. In investing, whoever is forced to sell loses. Year 2. Build cash flow, not just net worth. In Year 2, the focus shifts from protection to predictability. Billionaires care deeply about cash flow because cash flow buys time, and time compounds. This is where 20 to 30% of your portfolio should begin moving into income-producing assets, rental real estate, dividend-paying equities, or private credit. These assets won't excite dinner party conversations, but they pay you while you sleep, while markets fluctuate, and while your attention is elsewhere. Here's the mindset shift. Paper gains feel good, but cash flow keeps you calm during volatility. When markets crash, the investor who is still getting paid is the one buying assets at discounts. If you've ever wondered why the wealthy seem relaxed during recessions, this is why. Year 3. Take intelligent, asymmetric risks. By Year 3, your foundation is strong enough to absorb risk, but only controlled risk. This is where many people self-sabotage by going all in emotionally. Limit high-risk, high-reward investments to 10 to 20% of your portfolio. This includes startups, venture capital, emerging technologies, crypto, or speculative plays. Expect most of these investments to fail. That's not pessimism, it's math. The rule is simple. One winner must cover all losses and still deliver meaningful upside. If an investment can ruin you, it's not an opportunity, it's a gamble. Billionaires don't chase every trend. They place small, thoughtful bets where the downside is capped and the upside is asymmetric. Year 4. Think globally, not locally. Most entrepreneurs are dangerously overexposed to one country, one currency, and one political system. Year 4 is about resilience. True diversification means owning assets across multiple geographies and currencies. This might include international equities, foreign real estate, or funds operating in different jurisdictions. Wealth is not just about returns, it's about durability. History shows us that markets recover, but governments change, currencies weaken, and regulations shift. The globally diversified investor doesn't panic when headlines change. They adapt. The goal is simple. No single country should control your financial destiny. Year 5. Optimize, structure, and scale. By Year 5, you stop thinking like an investor and start thinking like a wealth architect. Leverage, when used conservatively, can accelerate growth, but only on cash-flowing assets and only when survival is guaranteed. Fixed-rate debt on stable assets can be a tool. Leverage on speculative assets is a liability disguised as confidence. This is also where tax strategy becomes inseparable from investment strategy. Legal structures, holding companies, trusts, and reinvestment vehicles can dramatically reduce friction. The wealthy don't earn more because they're smarter. They keep more because they're structured. The goal at this stage is not higher risk, it's efficiency and longevity. The billionaire mental model. You must remember, here's what separates enduring wealth from temporary success. Concentrate to build wealth. Diversify to keep it. Boring money funds exciting opportunities. Time in the market beats timing the market. Optionality is your greatest asset. Protect it relentlessly. If you do this correctly, the journey will feel slow at first. Then it will feel intelligent. Eventually, it will feel inevitable. Most people chase excitement. The wealthy design systems that compound quietly. If this video changed the way you think about money, even slightly, leave a comment below and share what stage of the journey you're currently in. If you found value here, like this video, so it reaches other entrepreneurs who need to hear this message. And if you want more insights on wealth, strategy, and long-term thinking, subscribe, because building wealth is not a sprint, it's a discipline. Your future self will thank you for starting today.